As I'm sure you would also recognize, withholding taxes is a big issue for the larger companies. I think what you would have also seen over time is that the medium-sized entities and even some of the smaller entities are also grappling with the same issues. And that's why we're presenting this session in this SME line today. Now, without going into too much detail as to the policy reasons why these withholding taxes would be there or not, I think it is important to understand some of the background as to why are we dealing with these issues. In the first place, what's the reasons for these withholding taxes? If we look at it from an administrative point of view, for a lot of these countries that are imposing the withholding taxes, it's a matter of ease of collection. So if you collect the tax before the money leaves the country, rather than to go and look for someone else once they're out of the country, it's a lot easier to collect this tax. Then the second matter, or the second aspect of it, and I think we see with all of the talk about base erosion and profit shifting, we do see more and more of these withholding taxes. Withholding tax is also quite a good way to firstly make sure that you collect your money, and there's less room for manipulation, seeing that you don't get any recognition for the expenditure that you incur. So it's a rather clean way to say that you've got your income amount, you can see what the amount is that's going out, and there's a percentage on that. Of course, the withholding tax rate should be quite a lot lower than your normal tax rate, and that's where you get your recognition for the expenses. As we will see on the next few slides, it doesn't always happen that way. Okay, so before we start going into the technical provisions to say what rebate do you get and when do you get that rebate, if we look at what is the impact of a withholding tax. So does the introduction of a withholding tax necessarily mean that you have to now charge your client more for the work that you're doing? And what you'll see throughout the session, I'm going to be talking about services a lot, seeing that that's where the withholding tax issue comes out quite clearly. Okay, so the first scenario that we're looking at, we've got the payor and the recipient, who's the person earning the income, so doing the work. Without the withholding tax, the payor would make a payment of 100 to the recipient. Let's assume that in the recipient's home country, there's a tax rate of 25%. That would be in South Africa, it would have been 28%. And in the home country, the recipient would have been taxed on the 100 at 25%, giving them 25 Rand of tax. If a 15% withholding tax is now introduced, there would be 15% withheld at the source. There would only be cash of 85 arriving at the recipient. But what you would find is that most countries where you tax based on residence would then give you a credit for the fact that you've already paid tax on this amount. So the country of residence would give you some recognition for that, and that would leave you with a 10 tax in your home country. So does it really change the position of the recipient of the income in this instance? Arguably, from an overall perspective, it doesn't. So why do we still see a lot of these agreements that would say if there's a withholding tax, we're going to uplift the sales price immediately? So quite often what's going to happen is as soon as the withholding tax comes in, that 100 becomes 115 to put the recipient back into the position where it would have been. The issue here is often timing of the cash flow. Your withholding tax is going to mean that you've got less cash to work with, whereas your tax in the home country would have been a tax that you paid only at the time of assessment. So timing could be an issue here, but looking at it from an overall perspective, you're not necessarily in a worse off position than you would have been. Okay, where it does become problematic, and the withholding tax on service fees would illustrate that quite well, is the following scenario. You've got, again, 100 going to the recipient of the income. You've got operating costs of 80 now, and that's really the difference between this scenario and the previous one. Something like services, there will be operating